All right, welcome back everyone. Joining us to discuss portfolio strategies for 2020 from an ETF perspective is Dan Kraninger. He's president and CEO of NorthCoast Asset Management. Thanks for being here, Dan.
Thank you. Thanks for having me.
So when we're talking about portfolio strategies for 2020 from an ETF perspective, I mean, what a year it's been this year.
Fantastic.
Big gains, but a lot of bumps along the way, providing the case and the need for investors really to be tactical with their positions.
Yeah, we think so. I mean, we think there's two big problems for investors today. One is, how do I drive income into account? Short yields are 1.6, long yields are 2.3, but how do I get a monthly check, especially if I'm using my portfolio to generate that income? How do I do that? We have a solution for that we call tactical income. And then if you're trying to grow your capital still, how do you grow your capital and be cautious about potential bear market risks? Those are the two big things we try to solve for with ETFs.
Right, so you have ETF portfolios then. How do you go about constructing those?
Well, that's an important question. I mean, for growth, I'll start there on tactical growth. The first thing we do is we consider the market risk. And for us, the market risk falls into four dimensions. We care about technicals. It's an auction market. Are people buying? We care about valuation, how much you're spending for that. We care about the macroeconomy. How good is it? How productivity, jobs, things like that. And then we care about sentiment. Are people optimistic about the future? And we measure those indicators, and that gives us a view on whether we think the market is a good place to invest right now. Right now, for us, we're about 30% hedged. So we're about 70% long, about 30% hedged. Once we decide that, then we move into security selection. What do you want to buy? And for that, again, we build models. We kind of sit at the intersection of art and science, where we take things we believe in and things that we think about the markets, and then we test them. Doesn't matter that an ETF is closing at a premium to its NAV. Doesn't matter that an ETF is gaining flows. Well, we take those concepts and then we test them and test them and test them with data and a lot of computer coding, and to build our selection process that's based on a risk-reward curve. Does it make sense to go into that ETF right now, given those ingredients? So that's our growth approach. Then on the income approach, we kind of do the same thing, but we spend a lot more time trying to measure the reliability of that, let's call it the interest payment and the income check coming through. So, two different approaches. One with an approach where we take a lot of concern about the market risk, and the other one really about the reliability of that income stream for the people that are trying to take a step up from cash or a step up from that first couple bonds they might have bought.